Hello, and welcome to Macro Minutes. During each episode, we will be joined by RBC Capital Markets experts to provide high-conviction insights on the latest developments in financial markets and the global economy. Please listen to the end of this recording for important disclosures.
Welcome back to Macro Minutes. Today is the 25th of June, 2026, and my name is Luis Estrada, and I shall be your host today. Joining me are Dasha Parkhomenko, our EMEA FX strategist, and Abbas Keshvani, our Asia macro strategist. Dasha and Abbas, welcome. We've had an eventful spring. The Iran conflict dominated headlines and FX sentiment, turning oil importers versus oil exporters into the key way of classifying currencies. Just as we were all becoming energy experts, the Strait of Hormuz reopened, and oil has returned to $70 per barrel. But the pace didn't slow down. There was no halftime, no water break. U.S. Treasuries sold off, experiencing a 2 standard deviation sell-off over a 3-month period ending in May. This triggered a broad bond market sell-off in emerging markets. The markets are now pricing almost 50 basis points of Fed hikes, a dramatic shift from February when the market was pricing cuts for the third quarter of 2026 in the U.S. The implication is ironic. The new Fed chair, Kevin Warsh, could potentially be the one hiking rates. That's controversial given that Warsh was appointed by President Trump and is widely viewed as someone biased to ease rates. As a result, many analysts have just ignored the market and pushed their expectations for Fed easing into the 2027 cycle. All of this is unfolding just as the FIFA World Cup kicks off, adding another layer of distraction and disruption to markets. As the summer of soccer gets underway, and assuming geopolitical tensions and treasury volatility begins to settle, let's dive into our latest views. Dasha, let's start with the dollar. How do you expect the US dollar to behave over the summer?
Thank you, Luis. So it's a very timely question. One, because we just updated our forecasts, and second, we've seen a very sharp rally in the US dollar since the lows that were seen back in May. The way that we view the dollar is that there's potentially further upside momentum in the DXY into year end and the early part of 2027. But I think that during this period, because you've seen right now the dollar is overbought based on the technical outlook, and also markets are net long dollars, which means that most likely the pace of further gains is going to be slower from here than what we've seen in the past 1 to 2 months. In terms of how we're thinking about the US dollar outlook for the next roughly 6 months, when we think about last year and for a good portion of this year as well, markets and ourselves included were bearish on the US dollar for largely 3 reasons. The first was this idea that the Fed was going to cut rates that would cause a narrowing in the rates differential between the US dollar and the rest of G10, and that would translate into higher hedge ratios by foreigners on dollar assets and thereby translate into dollar selling. The second driver was diversification out of the US into the rest of the world, into Europe, into Asia as well. And then the third factor was this idea of US policy uncertainty causing a higher risk premium on US assets, and that's translating into more hedging of dollar exposure. Now, I think the landscape has changed. The first change is that our US rates team is no longer expecting rate cuts. So if we take that into account and also our views on other G10 central banks, then the rates differential between the US dollar and in particular the lower yielding currencies in the G10 space is likely to remain wide. The second is if we were to look at US Treasury's TIG data, which looks at cross-border financial flows between US and the rest of the world, we've seen almost consistent net flows into the US since the start of Trump's second term back in January 2025. There were only 2 months where there were net capital outflows. One was January 2025, which we can think of as being the peak US exceptionalism. And then the second month was when we had Liberation Day, and that was the month of April. And then the third factor that I think has changed is that last week we had the Fed meeting, as you mentioned, with Kevin Warsh. And I think one of the main takeaways for us is that Warsh's first meeting has removed the Fed independence concerns. So in all, that leaves us with a view that there's further space for the dollar to gain by the turn of the year, in particular against the lower yielding currencies.
Perfect. Abbas, the CNH has been remarkably insulated from much of the FX volatility we've seen elsewhere. What's your outlook for CNH this summer, and how much of that depends on the direction of the dollar?
Well, Luis, as you know, we've been bullish on CNH since November, and we've had a long CNH trade on versus dollars and euros equally weighted. The trade is making something like 4.7% total return, including carry and bid offer. So I am naturally very protective of this PNL, and I'm constantly vigilant about any kind of turn in CNH. But so far, I've been happy to see the PBOC continuing to fix dollar CNY lower. And this has happened even as the dollar started moving higher over the course of the war. So we saw the euro weaken, we saw the yen weaken, but we saw the PBOC continuing to fix CNY stronger. And I think that speaks to the fact that they have ambitions for internationalization of the currency. And also, there is increasing external pressure on them to keep appreciating the yuan. So that's kept them on an appreciation bias. And we'll get to, I'll touch more on this in a little bit, but so far it has worked out quite well. China's fundamentals are also pretty solid and favor a stronger currency. The trade surplus is absolutely solid. Last year's surplus was something like 1.2 trillion yuan, and increasingly the exporters exhibit a tendency to convert this surplus, which is very important in terms of transmission into currency strength. And finally, the currency also exhibits tremendous safe haven properties. We've seen Chinese bonds relatively insulated from the inflationary impacts of the war, which has allowed them to function as a sort of haven since the start of the war, and it's allowed CNY to function as a haven in part. It also helps that China obviously doesn't import as much energy than a lot of its other peers in Asia, right? So all of this kind of informs, a relatively constructive approach towards CNY. We're also looking forward to a specific catalyst, which is, we want to wait for additional incremental fiscal stimulus, which would improve the cyclical outlook for China, and that would be the next leg lower in dollar CNH. So that's essentially why we have this bullish CNH stance. We continue to hold it, but I will say that over the last week or so, I have noted with some caution that the PBOC have started to fix dollar CNY higher. We've had a 5-day streak of higher fixes now, which is the longest such streak in around 2 months. So it does warrant a little bit of scrutiny. I'm very mindful of the fact that clearly they don't have the same bias for steering the currency stronger as they did, say, a month ago. And I'm very watchful for any kind of shift in fixing approach or a currency appreciation approach. I'm also worried about, the trade talks between the EU and China, because if the EU decides to respond to what they see as imbalances, if they respond to that with tariffs or some kind of protectionist measure against Chinese exports, then there's less of an impetus for China to keep fixing the currency stronger. So, the first point which I raised, which is, we see the PBOC continuing to fix CNY stronger. That point needs special attention over the coming weeks, just because if there's a shift in stance, it would warrant us taking profit on our bullish CNH view.
Luis, let's turn it back to you now. Through all of this volatility, the high-yielding currencies in Latin America have outperformed in the first half of 2026. What is your view for the summer?
Good question, Dasha. I believe the carry will continue to outperform over the summer, but given that the dollar is going to be strong, we prefer using lower yielding currencies to fund these carry trades, but definitely not using the dollar. Trades like BRL, Japanese yen remain very attractive. We think these can reach 32 sometime by the end of the summer. Speaking of the lower yielders, what are your favorite funding currencies and which EMEA trade stands out heading into the summer?
Yeah, so on the first part of your question, Luis, I did do some work around this topic recently in terms of what are the better funding currencies. For context, we have a carry trade barometer that screens for efficient funding currencies for each high-yielding currency in both G10 and EM. And the one currency that stands out as the most efficient funder is Swiss franc, in particular looking against long HUF, long Polish zloty, also against a number of Latin American currencies too, for example, long BRL, which you like. So the Swiss franc tends to be one of the better funding currencies based on our carry trade barometer. Now, if I can deviate a little bit from the carry theme, I do think that there is potentially scope for a relative value play over the coming months when you look at the Polish zloty versus the Czech koruna. And specifically, there may be some space for the Polish zloty to underperform versus the Czech koruna. And there's two factors behind that. One is if we're correct in our view on the dollar, and the dollar does continue to move higher towards the end of the year and into the early part of next year, then we should see an environment where PLN Czech ends up trading below a support that comes in at 564. That is the low from the middle of 2024. And that would be a very significant level if that pair were able to break below it. The second factor is a little bit more of a relative rate story, which is on the one hand, you have the National Bank of Poland. We do expect them to be on hold for the foreseeable future, but I do think that their tone has been turning a little bit more dovish. That can potentially weigh on the Polish zloty, whereas you have on the other end of the spectrum, you have the Czech National Bank. They delivered a hike at their June meeting. You did have one of the members from the CNB saying that this is not the start of the tightening cycle. But I do think that in relative terms, the National Bank of Poland is more dovish right now than the Czech National Bank, which means that you could potentially have more downside momentum in that pair, PLN Czech. So that would be a pair I would watch if you do get more dollar strength, even if it's gradual, and if you do have that relative rates dynamic story playing out. Abbas, heading into the summer and assuming that lower oil generally helps FX and bond volatility declines, what are your strongest convictions in Asia?
Well, Dasha, my strongest convictions in Asia are that I would like to turn more constructive on the energy importers because a lot of our currencies here in Asia are energy importers and they depend on imports of oil and gas. So they've had a rough last few months because of the war and higher oil prices. And I'm thinking specifically about the Korean won and the Thai baht. These are two currencies that have really depreciated since the start of the war. And now that oil prices, are below $80 in Brent, the environment is a lot more forgiving to these currencies. And actually, some of their macro fundamentals can stand out. In Korea's case, we've got the ongoing WIGB inclusion, which is worth 7 yards of inflows, FX unhedged per month, and that's no chip change. It's equivalent to Korea's average trade surplus for last year. So that's a lot of money coming in, and I think it would be sufficient to strengthen the currency. I also note, and this is not about the war necessarily, but I also note that, some of the drags on the won, like the retail outflows or the portfolio rebalancing by the foreign investors, they appear to be behind us, or at least they've dissipated significantly. So the drags on this currency are less, the thrusts are still live, and the wartime considerations that kept me at bay are fading in the background. So I do like the Korean won. I think on a relative basis, it might be a good one to turn constructive on. Certainly not against the dollar right now, just because of the British tone in dollar Asia, but I'm certainly on an RV basis. That's something I'm looking at potentially. And then the Thai baht is another one I really like. Outside of a wartime scenario, Thailand enjoys solid tourist arrivals, which are responsible for $2 to $3 billion of inflows into the country. And that's enough to basically strengthen the currency on a protracted basis. So I do like this currency. I think it's weakened a great deal since the war, and this is actually looking like a pretty attractive entry level. So I've got that on my radar. Again, more in the RV space than anything else. I'm certainly not against dollars right now, but Korea and Thai baht, these are potentially two trades I think could work out quite well given lower oil prices.
Thank you, Abbas. So let me turn it back to you again, Luis. There's quite a few political and idiosyncratic events in Latin America. What are the risks for Latin America carry trades over the summer months?
Well, I think the biggest risk is that the market is right and the Fed actually ends up hiking in 2026. That would completely reverse the current carry narrative. The second and more idiosyncratic risk, I would say, is the outcome of the USMCA negotiations. We should have much more clarity over the next few months, and that will likely determine the direction for the Mexican peso and the Canadian dollar. As we head deeper into the summer, the macro narrative remains a delicate balance between stabilizing geopolitics, elevated but potentially peaking rates, and resilient carry dynamics across EM. If volatility continues to ease, the search for yield could persist, but the margin for error is thin. Always, dollar strength could quickly disrupt flows. Be sure to join us next month as we continue to navigate emerging markets together. Dasha and Abbas, thank you for joining me on the show. To our listeners, thank you for tuning in. For additional insights, please reach out to us or to your RBC sales representative.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.